What we lack here is savings. We consume too much. So we need to think about policies within the United States that force us to save and consume less.
Hello, gentlemen. Are you ready for question time again? You may simply
Always
raise your
ready.
hand or
Always
shake your
ready.
head. Always. Okay.
Always ready.
There's a lot of talk today about inflation and economic forces and that kind of a conversation going on. But I remember back in the 90s, and I think you guys do too, when economists were patting themselves on the back, saying that they had defeated inflation, and they broke their arms patting themselves on the back. But Joe, in some things you've written here lately, you said there may be another force that was involved in that, and it may be about to come to an end.
Yeah, that was the mid 90s there, starting in the mid 90s, really throughout the 90s into the late 90s. It's what the economists took to calling the great moderation, that inflation was under control and it was all because of central bankers. And I'm going to tell you that I think that they really, yeah, put it this way, they saw a goal and they wanted to take credit for it, so they did. Because anything to do with inflation must have to be with about central banks, right? I mean, it has to be. Yeah, well, we know that's not true. Inflation is, I suppose, everywhere and everywhere, or anywhere and everywhere, a monetary phenomenon, but there's more to it than that. And I think that, really what we're talking about is the supply and demand for money. But there are other things in the world going on other than what's going on at the Federal Reserve. And starting in the mid 90s, we got China entering the equation. China entered the trade conversation around then by devaluing the yuan by a big amount, and 25% or so in 1994. And if you go and look at the numbers, it's pretty obvious where the great moderation came from. It didn't have anything to do with the Mariner Eccles building down on down in Washington, D.C. It had nothing to do with Alan Greenspan. How it had to do with was China flooding the world with cheap products because they had very, very cheap labor, and they used that cheap labor to jump into the manufacturing world and export those manufactured goods around the world. And if you look at it, really, that price competition, if you want to call it that, that's part of the equation here. But if you look at durable goods orders, or excuse me, durable goods prices, you can see this very starkly. And I think Bob's going to have a chart for this. Durable goods prices started to fall almost exactly when China entered and devalued the yuan and started flooding the world with cheap goods. Now, look, by the way, cheap goods are not a bad thing. I mean, but it did have an impact on inflation here in the United States and had an impact on the economy for all those goods that they started manufacturing in the 90s that we used to manufacture. And it's not just us, it had affected every country in the world that had any manufacturing capacity. But you can see, if you look at that chart, durable goods prices started to fall in the mid 90s, 1995, right when they devalued the yuan, right when they came in to really start manufacturing and exporting. And since that time, since 1995, durable goods prices have fallen at a 1.3% annual rate. Fallen. I'm talking about deflation here. And that was interrupted briefly during COVID because of supply chain issues, but it has resumed. So durable goods prices are back to falling. Now, the effect there on overall inflation can be seen if you just look at goods prices by themselves, not durable goods, but just the total goods. Those prices rose since 1990. I don't know why I chose 1990. Actually, I should have gone to 95. But if you look at from 1990, 0.87% a year. So where did the inflation come from? Well, because we did have inflation, by the way, even though it was low. Well, the inflation came from the services side, which was all domestic. So you couldn't outsource in a sense, or you can to some degree, but not to the degree you can manufacturing. You can't outsource, haircuts, for instance, just to pick a really simple one. You can't outsource your haircut to China. Um, I suppose if you're in California and San Diego, you could outsource it to Tijuana, but I don't think you're going to outsource it to Beijing. So all the inflation that we had since the mid 90s, whatever we had, came from the services side of the equation. And so how did China do this? Well, China did this by having this cheap labor. Well, here's the problem, and here's why we think this might be coming to an end, and why we're worried and expect really a more inflationary future. Their wages have risen now, and their wages, in fact, now are above Mexico by about a third, I do believe. So you can manufacture cheaper in Mexico than you can in Canada, excuse me, than you can in China. But of course, there's limits to what you can do in Mexico. China's a more advanced society in some ways, not just economically, but educationally in a lot of different ways than say Mexico is. So they produce more high tech products and things like that than you're going to get out of Mexico so much. But the point is that that's starting to end now. And by the way, China's population is peaking or has peaked. I don't know. Steve probably got better numbers on that. He follows this closer than I do. I think their population may have peaked, but certainly the dependency ratio is going in the wrong direction. This is also part of China's policy, right? Go back, remember, throughout most of my adult life, they had what was called the one child policy. They didn't want to have too many people, so they said one child. You only got one. And by the way, boys were favored over girls, so you got a lot more boys than girls. And so now you've got this situation where you don't have enough young people entering working age to be able to support all these old people that are in China. And it's going to be inflationary, not only here, but also in China to some degree. Now, China right recently has been having some deflation. But look, all of this stuff is about trade. And this is why, you know, like I said, it's a trade-off, right? If you have free trade and even if everybody doesn't agree to or doesn't abide by the rules, so to speak, which is why we had things like the WTO, which never really enforced the rules against China. Even if they don't, you do get something good out of it. You get cheap goods, but there's a blowback too. And that's what we're seeing right now. That's why we have Donald Trump as president again. That's why we got him the first time, was because there's a whole group of people in the United States that were hurt by this. And listen, that's what trade is. It's what all economic policies are. There's no free lunches. You want cheap goods? Well, somebody's got to pay. No free lunches at all. And so, now we get the blowback, and now we're trying to fix it. And I'm not sure you really can at this point, because we've got the same problem as China as far as demographics are concerned. You can try to bring manufacturing back to the United States, but who's going to man these factories? We don't have enough people to do that right now. Now, I suppose, Donald Trump and Elon Musk, their answer would be, well, we just fired a bunch of people for federal government. Maybe we should put them to work. That may be true, but even there's not enough of them. And so it's going to be interesting to see how all this plays out. And by the way, I do want to say this, and because we've talked about this before about tariffs and inflation. Tariffs in and of themselves are not inflationary. They will have an impact on prices, but it's usually, or at least it should be well, let me say this differently. If it is targeted tariffs where it's targeting a specific product, you're not going to get inflation. That one product may go up in price, but some other product is going to go down in price. It's called a relative price change, and that's not inflation. If you do across the board tariffs, on the other hand, you could end up with long-term inflation. But what you're going to get first is a step change in prices. Prices will go up, but inflation is a rate. It's not a level. And so if we do impose these tariffs, which, that's a whole different topic about how that's happening and how that's playing out right now. But if you do that, you do get a one-time step in prices, but then you have to see what happens after that. If tariffs stay in place, you end up with what we've seen in the past in countries where they've had high tariff barriers. You end up with an inefficient economy. You end up with lousy products because there's no competition. There's lots of downsides to tariffs too. My point is, you can't fix this problem. We ignored it for 30 years, and now you can't fix it with tariffs. And so I'm not sure where we go from here, except to say that somebody's going to have to manufacture the goods that everybody consumes, or we're going to have to consume less. And that really may be the answer right there, is to consume less. We'll see what happens.
Steve, I want to go back to that dependency ratio, and these are some numbers that I got from you. And for people, the dependency ratio is going up in China, and dependency is considered age 0 to 14 and anybody over 65. So right now, old age dependency is expected to go up to 52%. And that would mean that they would have two people working in China for every one person that's not working. And they said that the dependency ratio could go up to 89% by 2085. That sounds a lot like the US.
I mean, to a degree, right? And I think this is part of the inflation argument we're making is that this isn't about one country. This is really kind of a global issue of aging populations and by proportion fewer workers. Um, and I really want to kind of tip my hat here to Joe because uh, a lot of people are covering the demographic decline, the issue globally. A lot of people are covering China, which we're speaking about here specifically. I haven't seen or heard too many people zero in the way that Joe did in some of his research and showing why this is inflationary. And it's pretty commonsensical, despite the Japan example that kind of pushed people in the wrong direction on this. But as you have fewer workers, labor costs are going to go up. I'll repeat that because it seems to be too complex for some people to follow. As you have fewer workers, labor costs will go up. And as Joe pointed out, when you had more workers and costs went down, the central bankers, went out and they threw a parade for themselves and look at what we've achieved with monetary policy. Well, no, it wasn't. And the reverse is starting to happen. So I kind of want to point that out as a really important note that a lot of people have missed in this that Alhambra's doing a good job covering, and I think Joe really did a really good job in terms of saying, hey, here's why dependency ratios really matter in terms of inflation and deflation, why we got a problem on our hands from an inflationary perspective. And as he points out, labor costs have been going up in China as they have fewer workers. Um, some of the numbers here are the United Nations sees, China's population, some of those projections like, possibly, halving almost by the end of the century. In terms of the US versus China comparison, you're pointing to, some numbers have about by 2050, close to a third of the Chinese population being 65 or older. That's versus the US, where it'd be more around a quarter. So China is, materially worse off here, and it also goes to some of the factors that Joe pointed out. They do have a preference for boys over girls that create an imbalance of somewhere around 20 or 30 million. Men can't have babies, so it's a problem for you. Urbanization was a problem. You get declining birth rates with urbanization. But another problem was that one child policy the state instituted and followed up with measures like forced abortions and other penalties. And it worked really effectively, so effectively that their demographic dividend was probably around 2013 going on that. That was probably their peak of having a workforce population. And that kind of isn't too far off from the 2008 period, which was probably the peak of their export development model. Um, and it got them to be in the workforce of the world, which is kind of why we're covering it here. About a third of global manufacturing coming out of China. So as their labor costs go higher than Mexico, keep escalating, that inflation gets passed on. And even though you can look to outsource to Vietnam, outsource to Mexico, companies like Apple are finding you can't unwind those chains real quick. And even if you can, there's no country that can replace China. And then we get to the issue that, demographically, this is an issue around the world. But China here is really matters because it became such a share of global manufacturing. As Joe pointed out, it joining the WTO was really a force driving disinflation or even deflation. We're going to see the reverse happening. Something else I would also throw out with these numbers is they're almost assuredly too optimistic. One thing we know with the Chinese numbers is they're not accurate. I think we've had GDP numbers sometimes released before the quarter is over, and they managed to hit exactly what the targets were. So we know they're playing with their numbers to make them less bad than they are. So the inflationary impact is probably even higher. And then the last thing I would just throw in here is something else that Joe's pointed around the instability of this. But we are in a period right now where Chinese soft power, economic power is declining as their military power raises creates a greater probability of destabilizing international incidences that can destabilize supply chains. On top of that, the tariff war, wars we're seeing. But I think all this kind of points to a global phenomenon we've talked about of a secular inflation trend and an aging Chinese population, fewer workers, higher labor costs. It's impacting the entire world, and it's just getting started.
So, Joe, forgive me for not remembering whether I read this in something you wrote or if it was somewhere else, but I read the number that you have to have a per child household birth rate of 2.1% just to maintain workforce. And I think you said we're below that. China's below that now.
Well, it's not 2.1%, it's a 2.1, but I hear what you're
Oh,
saying. Yeah, you got to
yeah.
have a number over two. Uh, but we're not even close. I'm not even sure what ours is right now. I think it's 1.6 or something like that, but I'm not sure exactly. But it's pretty low. But I want to go somewhere else a little bit here too. Uh, all of this that we're talking about is really why we're having the tariff discussion that we're having. That's why we're having this conversation. And I think that there's probably some misconceptions out there about a lot of things in trade. But let's talk about a little bit about why I said, during COVID, we saw a little spike in durable goods prices and it started to go back down. And even after 2018, we continued to see prices fall. And at the same time, we saw a drop in the amount of goods being imported from China. So I want to address that just a little bit because I think it's kind of interesting. People have this idea that the tariffs automatically, well, we're gonna put tariffs on China. We're not gonna import as much stuff from China. That's true, but we imported more stuff from Vietnam. Why is that? Oh, well, listen, what tariffs did in the first Trump term was actually accelerate a trend that was already in place because the Chinese know that their labor costs are rising. They know that if they're going to continue to raise their export market, because that's where they're getting their growth from, they've got to do it some other way. So what did they do? They pushed production from China into Vietnam because Vietnam had lower wage costs. By the way, they also pushed it into Mexico because they have lower wage costs now. So that trend where we got prices falling again after COVID with a little interruption in COVID. Now we got prices falling again. But how long can that last? And especially now that the president has said, well, Mexico has got to push back on this. Here's another thing too, I think people are missing. And I know this only because of where I worked in my previous life prior to Alhambra. But tariffs are like anything else like this, any other tax, just like any other tax, it's meant to be evaded. And there are ways to do that. I'll just give you a quick example. So when I worked in Miami, a lot of my clients were in Brazil, and Brazil had very strict capital controls. You couldn't get money out of the country, or it was pretty easy to get it in. It was really hard to get it out. But you know what? Brazilians are pretty clever people, and they had ways to get it out. How did they get it out? Well, gee, what if they just bought a product from outside the country and they got invoiced for it? And what if that product, what if it normally cost $10 and the invoice said it was $20? So they're going to send that $20 overseas when the product only cost 10. Well, now they got more money out of the country than they wanted to. And by the way, most of the time, the company on the other side that they were paying actually belonged to them, and the invoice was false. Now, think about this in terms of tariffs. Do you really think that we've actually imported less from China? Well, maybe we have to some degree because now we're getting it from Vietnam and Mexico. But what about this? Here's an idea. And I just thought about this morning. So it's not that hard. And if I figured it out in the morning, you can believe that the Chinese figured it out a long time before I did. Okay, so let's say that we've got this product coming into the United States from China, and we know it normally costs $100. Okay, so if we put a tariff on that of 25%, no, 20%, that's what the one was for China. Now it's $120. It's going to cost us $100 for the product, and it's going to cost us 20 bucks in the tariff if I'm the importer. Okay, well, what about this? What if we said that we're going to invoice this thing at 80 bucks instead of 100 bucks? And China's not going to eat that 20 bucks. So what they're going to say is, we've got this consulting company over here in the British Virgin Islands. And if you pay our consulting fee over here, then you can get your product at 80 bucks. Now the Chinese company gets their 100 bucks. The US company, the US importer pays a lower tariff. He got the same cost of goods as he did before. Uh, and nobody's the wiser. Look, all rules like this are meant to be evaded in some way or shape or form. People are clever as hell. They're going to trade. And so we have to think about this when we think about what we're trying to do. we're trying to wall ourselves off from the rest of the world. It's not going to work. And so we have to figure out other ways to address the problems that we have. And here is the simplest way. What we have to do in this country, if we want to solve this problem, is we have to concentrate on ourselves. And what do I mean by that? What I mean is what we lack here is savings. We consume too much. So we need to think about policies within the United States that force us to save and consume less. And if we do that, then we will have a smaller trade deficit, and we will have, hopefully, a smaller budget deficit too, because that's part of this equation. If you're trying to reduce the trade deficit, you have to reduce the current account deficit. You have to save more, which means you need to spend less. And that could be at the federal government level. It could be at the individual level. It could be at the corporate level. It does not matter. The big dissaver right now is the US government. You need to do something about the budget, but we need to get savings rates higher too. And so if we consume less, we can solve this problem. But that's an internal problem. It's not something we can force other countries to solve for us. We have to solve it on our own. And by the way, I think we can do that. There are definitely policies that we can do, we can impose or implement here in the United States that would help us accomplish these things. So I think that the tariff issue is really a distraction. They've identified the problem. There's no doubt about that. Donald Trump in particular recognized this problem and said, we've got a problem here. But the solution is they're trying they're just concentrating on the effect. They're not getting to the root cause. And that's where we've got to do better. We've got to figure out how to get to the root cause. And I hope that this administration will do that. I think they're discovering that just imposing tariffs is a really difficult thing to do. It's a policy with a ton of moving parts. And I'm not going to go into this now, but I got to tell you, we're going to do another one of these, and we're going to talk about free markets. Because I got to tell you, I read a memo the other day that President Trump wrote about lumber tariffs, where he directed someone in the administration to investigate the national security implications of lumber imports. There are no national security implications, period. End of story. But I will tell you that this document read like something right out of the Soviet Union, because he directed them to look at supply and demand of lumber and decide how much we needed to import and how much we needed to do locally. I got to tell you something, that ain't free markets, guys. And that is not where we need to be going, because we know what happened to the Soviet Union. We know what happens in socialism. It does not work. We do not need to substitute the judgment of Donald Trump for the market. It's not going to work. So anyway, we'll get into that another day.
So, Joe, you have given me some really great advice. If I consume less, there will be less of me, but I'm the one that has to make that decision. So I'm going to try and reduce my girth by consuming less. And say, if you haven't done it yet, sign up for our newsletter.